Stocks opened strong with the Nifty now back near the 22,300 level. Consumer durables and the industrial stocks are the big gainers, even as IT and utilities lag.
HDFC Bank posts an unexpected improvement in margins, but creation of a provision buffer of over 10,000 crores raises eyebrows. The CEO says the focus is on improving profitability matrix in the medium term, even as he avoids giving a guidance, calling it a distraction.
Wipro guides for a weak or steady FY25, offering little cause for optimism, even as new CEO Srinivas Pallia outlines 5 focus areas to help rebuild the IT services major, which analysts believe can be an uphill task.
Jio Financial Services gains after it lays out its plans for the future. IREDA climbs on strong growth and better credit quality, while Lupin and Zydus Life get a boost on starting sales of $1 billion US drug. But a sharp cut in tariffs by the gas regulator triggers a steep fall in GSPL, and profit-taking pulls down Persistent Systems. A very good afternoon. You're watching Halftime Report on CNBC-TV18. I'm Ekta Batran. With me is Mangalam Malu. Well, 8 days turning out to be a day where we are seeing follow-on buying coming in from Friday. So after all of the early morning jitters on Friday, we seem to have gotten past that. We've had quite a stable weekend as well in terms of news, and it seems to be reflecting on the screen as well. Asia was higher. We are higher right now. So up around 156 odd points for the Nifty, above the 20-day moving average, and the mid-cap index, which is outperforming as well. Just want to point out that the mid-cap index is not only outperforming for today, where it's up around 0.8%, but on a month-to-date basis, when the Nifty is just about lower by around 0.15% flat with a little bit of a negative bias, we have the mid-cap index, which is up around 2%. Let's see whether that sustains. Advanced decline ratio also positive.
Looks like it may sustain, Ekta, the kind of up move that we've seen. In fact, today was a classic case of the market opening higher after a big rally that we saw in the previous trading session. That seeing some bit of profit taking, and from the lows, we've seen another recovery. So the second recovery usually seen as a little more powerful for the market. So from the day's high, the Nifty fell closer to levels of around 22,250 odd, and from there, it's staged a recovery once again. So now sitting with a 150-point gain on the frontline index, firmly above the 20-day moving average, as Ekta pointed out. The mid-caps doing a lot better, and a lot of these mid-caps actually are spiking quite well. Exide, for instance, has been on a one-way up. This month, Exide is up 54%, and there's no signs of stopping that one. Up 6% ever since it's announced, its merger or its deal with Kia for electric vehicle batteries. That stock's been on a one-way tear, so up around 54% for this month, doing well now as well. Voltas is the other one. We've been talking about this heat wave and, strong demand in summer. So that stock is up around 6.5%. Gaming company on the way up is Whirlpool, which is up 5% as well. And Aditya Birla Fashion, ever since it's announced its demerger of 2 businesses, and now we got incremental details about debt distribution over the last 2 days on the exchanges as well. 3,000 crore debt, 1,000 crore would be given to the demerged entity, 2,000 crore in the resultant entity, with about 2,500 crore of fundraise. That stock too has moved higher with a gain of about 4.5%. So that's about a bunch of mid-caps actually doing very well, Ekta.
Yes, absolutely. Well, that seems to be where the action is. And in fact, for the Nifty as well, we've got a lot of frontline stocks which are doing well today as well. So, for example, BPCL, which is up around 3% odd, Axis, which is up around 2.5% odd. Tata Consumer, ahead of its results tomorrow, is holding up with a gain of around 2.5 to 3% odd. So a lot of these stocks are seeing some amount of traction on the upside. In fact, to put it into perspective, there are only 5 stocks which are declining within the Nifty. So that gives you a sense in terms of the strength that we're seeing within that space as well as for the broader markets. But nonetheless, let's kick off the show by talking about Honasa Consumer, which is surged in trade as its skin care brand, the Derma company or the Derma Co, achieves an annual revenue run rate of 500 crores. In our special segment, Value Add on Halftime Report, Mangalam's getting us the details on this. Mangalam.
But a couple of things that are really positive for Honasa, which is the owner of Mama Earth, is now that it's not only the owner of Mama Earth. It always had a lot of revenue coming from Mama Earth and some part of revenue coming in from the recent acquisitions that it made, be it, Aqualogica, the Derma Co, Dr. Shet's, or something like, B Blunt too. But now Derma Co has been one of the more successful non-Mama Earth brands in their portfolio, has now achieved an annual run rate of around 500 crores. Does this mean 500 crore for in terms of revenue for the last 12 months? No, but the last monthly revenue that they did equates to about 500 crores on an annual run rate basis. This is the second brand of the company after Mamaearth to go ahead and cross that annual run rate of 500 crores on revenue. And this has been growing fast for the company. In fact, in the first half of this year itself, as of September, the ARR was close to around 350 crores. And remember, at the end of the 9 months or the third quarter results, the company had said that this brand had also turned EBITDA positive. So not only is it revenue accretive, it's also not taking away from the margins, it's adding to the company's margins. And this really assuages analyst concerns about the company's ability to scale brands other than Mamaearth. Not just that, if you look at the 9-month numbers, the adjacent categories of the company have been doing well. Color care category, which they recently launched, has already crossed about 150 crores in annual run rate. Rosemary hair care, which was within 6 months of launch as of December, had crossed about 50 crores. So telling you that, the company's hero products, which are basically the onion hair shampoo as well as, the Ubtan business, are not the only ones. They are expanding their ancillary businesses. The company had told us earlier that consumer sentiment has seen some improvement in margin. In any case, it has been growing faster than all the other FMCG companies. But now, the key thing to track for Mamaearth, at least over the next couple of weeks, would be nearly 48.5% of its equity. That's about 16 crore shares come out of lock-in for sale. So there is impending supply, which is likely in the next 10 odd days. So this is one thing that I'll be watching out for, other than the ancillaries, which are doing well. Fundamentally, no real problems in terms of a stock price move. It surged past the initial dip that it saw after the IPO. And now, increased liquidity or increased supply pressures is the only imponderable that we'll keep an eye out on as of 2nd May. Ekta.
Okay, you got me quite tempted with all of the names of all of those products which you were talking about. Just feel
were you Googling some of them while we were talking?
Just feel like running off to a spa with all of those names. But nonetheless, the stock itself has risen around 24%, like you mentioned, from that issue price of around 324 rupees, which it listed at. Remember, it was a tepid listing. So since then, let's see where it goes. But nonetheless, it's gained around 24% from there. But nonetheless, let's talk about Nifty stock, and the big one for today. HDFC Bank is one of the top Nifty losers in an otherwise positive market. Abhishek is here to tell us about the Q4 numbers and what the market didn't like.
The market has actually didn't like the extra provisions that might have been created by them. So let's take it on both hands, given the fact that it increases liquidity in the balance sheet as well and strengthens the balance sheet for the buffer that they have built in. So the Q4, the net interest margin has surprised positively. Analysts were factoring a flat net interest margin or a decline of 5 to 6 basis points in net interest margin. However, net interest margin has come in at 3.44%, which is, up by 4 basis points sequentially. They have made a provision of 10,900 crore, which consists of, the stake sale in HDFC Credila, that money, as well as the tax write back that they had got. So they have used that to build provision buffer in the balance sheet, which has not gone down well with the street. Rundown of HDFCL, that non-individual portfolio continues. Asset quality improves. Gross NPA ratio is down by 2 basis points on a sequential basis. The LCR is also strong. It's strengthened to 115% versus 110% in the previous quarter. Fee income is strong. So if you take a look at the overall loans, they have increased by just 1.5% quarter on quarter. But in that, the retail portfolio growth is 4 to 5% on a sequential basis. And that's helped the fee income grow by 15% on a sequential basis. HDB Financial, that is a subsidiary of HDFC Finance, that's reported the lowest gross NPA ratio in last 18 quarters. And for the first time in 18 quarters below 2%. It has come in at 1.9% versus 2.25% in the previous quarter. Now, what doesn't work is that the risk weight to advances ratio from Q2 level of 92-93%, that's increased to about 99.3%. So that's not gone down well. Core operating profits have declined sequentially, but they have made a one-off, employee expenses of about 1,500 crore, which they have rewarded their employees with respect to the merger. And corporate loan books have declined on a sequential basis. That's impacted the overall loan growth as well. And that is on account of the fact that management did mention in the con call that they have not got favorable rates. That is why they have not gone for corporate portfolio growth. One-offs in the quarter, as I mentioned, employee expense of 1,500 crore and this provision of 10,900 crore, which was another one-off made in this quarter. PNL, NI is above our poll, while PAT is below our poll. Back to you.
All right, Abhishek, thanks a lot for that. That explains the movement of HDFC Bank. In fact, management in the conference call post the earnings, we, pulled out some of the conversation that happened. Shashidhar Jagdishan, who's the MD and CEO of the company, spoke about their key focus areas in the medium to long term, something that Abhishek alluded to as well. So let's hear out from the management itself some snippets of the conference call of HDFC Bank.
The key focus over the medium to long term, the medium as I define it between 2 and 3 years, is to focus on improving our profitability metrics defined as the ROAs and the earnings per share. To achieve that, what is key is to ensure the most important focus is the sustainability of our deposit franchise, especially the retail deposit franchise. And that's going to be achieved not because of any shortcuts that we can take. Yes, there is a price environment, there's a market intensity, there's a competitive environment that is there. That's a reality. But how do we ensure that we are on par with some of the key players in the market and we don't try and overprice ourselves or don't bid for some of these deposits is the strength of the franchise. We will continue to invest in distribution, in people and technology. In fact, our operating leverage will be harnessed over a period of time to using our enhanced tech and digital infrastructure. We've always emphasized, not just now, but for a long period of time, that we are not a quantity player, whether for liabilities or whether for assets as well. Our focus is on quality, which is a balance between risk and margins.
Okay, well, remember that brokerages such as Macquarie have maintained their outperform rating, have called HDFC Bank their top pick with a target price of around 2,000. And Nomura has also raised their target price on the stock. So important to remember that 1660 is what their target is on that particular counter. But not doing so well for GSPL as well. GSPL has slumped almost 20% as PNGRB has cut tariffs for GSPL's key HP pipeline. Sonal is here with the details on this particular story and how impacted GSPL is.
Well, yes, it's a big impact and negative as well for GSPL as the regulator PNGRB has gone ahead and cut tariffs for one of its key pipeline, the HP pipeline that is. And the cut is massive. It's cut by 47% to come in at 18.1 rupees per MMBTU versus the current tariffs of 34 rupees per MMBTU. And remember, GSPL had sought tariffs of 50.8 rupees per MMBTU. So it's around a 64% cut from those expected levels as well. The street was expecting a cut because of changes in macros and volumes as well, but that was to the tune of 10 to 15% only. The management said that it is studying the order right now, and some of the brokerages believe that they could go ahead and appeal against it as well. Also remember, Gujarat Gas is in focus because GSPL holds 54.2% stake in Gujarat Gas. The EPS impact of this one, the most important, could be to the tune of 30 to 40% in FY25, and hence that big cut that we are seeing on the stock right now. The reasons for the cut, higher volume assumption by PNGRB versus GSPL, and the economic life extension of the pipeline beyond the period that was expected as well. On the back of this news, the brokerages, they have gone ahead and cut target prices and downgraded the stock as well. Nomura, for instance, has cut their FY25 EBITDA estimates by 37 and 42%, EPS estimates by 34 and 40% for next two financial years. They have downgraded the stock to reduce with a target price of 320 rupees a share. Citi has a sell on the stock and target price has been cut to 295. MK has downgraded the stock to a reduce from a buy and target price has been cut by 11%. Lastly, Kotak has downgraded the stock to reduce. They expect the company to challenge the order. But yes, because of this news piece, the stock is lower. And we spoke to PNGRB where they did indicate that Gale's order is also expected very soon and it will be finalized by June. So that other stock is also in focus.
All right. Thanks a lot for that. In fact, let's listen into what Mr. A.K. Tiwari, who is the member of the PNGRB, said to us this morning.
We have given the 12% post-tax IRR that is there. That is as per the regulation. So there is no cut per se in the tariff. It is only adjustment. I can't say I can't commit that way whether it should be lower or higher. But 12% post-tax IRR is the benchmark of the in the regulation. So that is there. There is no question of any negotiation. If you see the performance of GSPL from the last 10 years, their volume has already been up, means 31 MMSCMD plus, and last year volume was 34 plus. So as per the regulation, we take the actual volume of the past years as well as the last year. So that way we have given, but they have projected that there will be some customers base, some customers will not take the volume. So they have projected 26 MMSCMD up to 2031, which we believe that may not be correct.
Okay, so that is PNGRB itself. Remember, GSPL is down around 20 odd percent. 52-week high for that particular stock stood at around 407 odd rupees. So it's corrected all the way to around 302. But remember that it's still away from its 52-week low of around 254. So let's see whether there's any kind of recovery from these levels eventually. But as we slip into a break, we have an announcement to share with you all. We are launching CNBC-TV18's first ever live personal finance webinar, CNBC-TV18 Accelerate Personal Finance Handbook with Sonia Shenoy, where she will be joined by 3 well-known experts on Saturday, 11th May, 9 a.m. onwards. We'll be diving into everything you need to know to master your finances and learn how to grow your wealth, be it insurance, tax saving, managing your portfolio, retirement planning. There's a lot to learn and do. Whether you're in your 20s, 30s or even 40s, this live webinar is for you. We have limited seats, so don't miss this chance. Register now. Scan the QR code to register or log on to CNBC-TV18.com. We'll see you on the 11th of May.
Welcome back. A bunch of stocks, they're spiking. We have Tata Consumer, of course, which has moved to the high point of trade ahead of numbers. Eicher Motors, the other one, which has moved higher, up around 3% for that counter. In fact, the top 5 or 6 gainers on the Nifty today reflect the kind of mood of the market. It's not concentrated to one particular sector. So the top gainer has to be Tata Consumer, followed by Eicher Motors. Then you have Axis Bank, which is doing well, Wipro and L&T. Between all of them, they cover the entire pack itself. So let's talk about Wipro itself, the IT major. Reported a largely inline set of numbers for the fourth quarter. Rima joins in with more details. Rima.
Thanks so much for that. So Q4 was in line, but the Q1 guidance was disappointing. It was at minus 1.5 to plus 0.5% lower than expectations. And that's resulted in the street now saying that perhaps in FY25, the company may not see any growth at all. So Ambit and Kotak, both of them have pegged their FY25 constant currency revenue growth to be flat with a negative bias. Now, Kotak says the new CEO has a difficult job of turning around a multi-year underperformance in a weak demand environment at a time of high leadership churn. So the question that we're asking is, then why is the stock up? If FY24, the company degrew by 4.5%, and in FY25 too, the company is unlikely to see any growth, then what explains the up move? For one, the stock went into its earnings on the back foot. Over the past 5 trading sessions, the stock ended in the red. So the stock had already fallen ahead of the numbers. 2, in Q4, there was a margin beat. Margins went up by 40 basis points, and that has caused the analysts to raise the EBIT margin expectations for FY25 and FY26. So now for FY25, Kotak sees a 30 basis points margin expansion compared to what they were earlier anticipating, and Nomura and HDFC Sec 2 has partially raised the FY25 and FY26 EBIT margin expectation. So some margin expectations have gone up, and plus the stock's valuations at 17 times are cheaper than the rest of the pack.
Okay, all right, Rima, thanks very much for that. In fact, let's listen in to what the management had to say regarding the company's discretionary spending, margins and the attrition rate.
Priority for us at this point in time is how do we execute to the 5 priorities that we called out, right? Whether it's to do with creating a large deal momentum, or whether it's to create a growth in some of our large accounts and also accounts that we think can be large accounts. We make sure we have the right solutions for the clients, which are infused with AI but consulting led. And then the last but not the least is building the skills which actually are very industry specific and also can be able, can offer the solutions that we have for the clients. So to me, instead of trying to predict what's going to happen, I think what's important for me and the team and for Wipro is to execute to what's coming in our way.
We are going to be range bound in terms of the margins that we have delivered over the last few quarters. If you look at our journey over the last 8 quarters, we've improved our margins. We've been consistently improving it. 60 basis points away from 17%. It is a milestone. It is an aspiration that we all have. But one step at a time. Revenue is very, very critical and the growth is very, very critical. We will remain very focused in investing for growth and drive operational excellence.
From an attrition perspective, I'm seeing that what we were seeing a declining trend over the last few quarters, it's plateauing now. Now, this could be a sign from what's green shoots which we are seeing in some of the sectors and consulting that if demand is picking up or it might pick up in the near term. First, we will honor every offer we have made. As we onboard freshers, we actually reach out to a group of people with the right skill and ask them who are interested, and then we onboard.
Okay, all right. Well, that's on Wipro, but let's now focus on another IT stock from the mid-cap space, Persistent Systems. The stock is down significantly as the margin guidance has disappointed. However, the company's constant currency revenue did see an uptick in the fourth quarter. Reema's here to tell us more, and there was a conference call earlier this morning as well. I think the key disappointment probably was from the commentary, Reema.
Well, yes. So Persistent conference call was at 8 a.m. in the morning, and this is what they had to say. During the next 12 months, given the challenging macro environment, our goal is to maintain top quartile growth while maintaining margins at the current level. So the 3 key takeaways from that. 1, the environment continues to remain challenging. 2, the company is likely to focus on industry-leading growth as it has been for a while now. And 3, the margins are likely to be flat in FY25 versus expectations of versus FY24. And herein may lie the disappointment for the street, because the street was hoping for some margin expansion. 3 months back, when the company came out with their Q3 numbers, I went back and looked at the street margin expectations for FY25. And, a Nuvama, a Kotak, they were all expecting a margin expansion of more than 100 basis points in FY25 over FY24, and that may not play out because the company is now talking about flat margins next year. Also, the company last year had given a medium-term aspiration of improving margins by 200 to 300 basis points. Does that get pushed behind? So that could be one element of the disappointment. On demand, the company in the conference call said that there is no change in the discretionary demand. Demand is as it was 2 to 3 quarters ago, similar to what we've heard from TCS, Wipro and Infosys. But another very important factor for Persistent is the fact that it's been a big outperformer and its valuations are higher than peers because of the kind of growth the company has been reporting. In the last 3 years, the stock is up 300% and valuations too at 35, 36 times are higher than its peers.
All right, Reema, thanks a lot for that. That explains why Persistent is down about 8%. But you're also looking at Vodafone Idea, the 18,000 crore rupee FPO closes today. Tell us more on the subscription details.
Yes, so Vodafone Idea's 18,000 crore FPO closes today, and as of now, the company is inching very close to achieving a full subscription. At 12 o'clock, it was 0.84 times, with QIB almost at 1, HNI being oversubscribed at 1.75 times, and retail being close to about 0.4%. But just to, so those are the subscription numbers, but they still have time till 5 p.m. And as I said, they're very close to achieving a full subscription. Now, this is important for the stock. The stock has corrected 6% in the month of April. Its all-time high level was 52-week high level was 18.1 rupees hit on 1st of January, and the FPO price is 10 to 11 rupees. The Aditya Birla Group has infused more than 2,000 crore rupees at a price of 14 rupees 87 paise. Now, this FPO, successful FPO, is important because this is growth capital for the company. The company will use this money to augment their 4G capacity, coverage, begin their 5G rollout, and once they have that, they're hopeful that the subscriber market share loss will get arrested. The street is also going to be watching out for potential tariff hikes post the election. But the bigger question is, right, in the near term, the money that they're going to be raising via this FPO, the bank, post, and also the bank lending will be enough for the company for the next 2 to 3 years. But will the company survive or will the company thrive? Will they have a right to win against its larger peers over the medium to longer term? And I think that's a question which will be answered in the next couple of years. Back to you.
Okay, all right, Reema, thanks very much for that. So that's on Vodafone. Need to take a short break. Ruchit Jain will join in to discuss technicals. Stay tuned.
Well, the Nifty has recovered from the lows, still hovering around that 20-day moving average. So if you just take a look at, the key indices, we have the Nifty Bank as well as the mid-cap index. The Nifty Bank is actually not gaining as much as the Nifty, and that's largely because of the weakness that we are seeing in HDFC Bank post numbers. Remember, it single-handedly lifted the Nifty Bank and the Nifty up on Friday from the lows. The Nifty still comfortable with a gain of almost 135 points. The broader market is doing a lot better. And as the markets moved higher, the India VIX has actually cooled off as well. So the India VIX is now down about 3.5–4%, just below that 13 mark. So that talks about the health of this up move. It's relatively better than what it was earlier. So this is a good thing. Importantly, the Nifty is around that 20-day moving average. Where it goes from here is extremely crucial. Does it go past it and cause for a lot more short covering, or does it just meander around these levels, or maybe look at a 20-day EMA halt as well? Looking at all these factors, the option writers have made their points pretty clear. 22,300 call is where a lot of the bears have written those options, telling you that levels upwards of 22,400 may face some resistance. And this is important because this is, for April series expiry that happens on Thursday. At the lower level, however, 22,200 put writers are equally active for a premium of almost 200 rupees, telling you that 22,000 is an important mark of support stocks which are in focus. I'm looking at Hindustan Copper and Nalco. Both these metal names may enter F&O ban, re-enter F&O ban rather. They exited F&O ban on Friday itself. And Balrampur Chini, actually, let's pull up the intraday chart of Balrampur Chini before we talk about the fact that it may exit F&O ban, because the open interest has fallen below that 80% mark. The stocks moved higher in anticipation of the stock's exit from F&O ban today. So as a result of which, we're seeing some traction out there, Ekta.
Okay, all right, Mangalam. So that's on the entire F&O space that is taking place. Let's get in a technical call now. Ruchit Jain joins in to discuss what he's strategizing today. Ruchit, hi, welcome to the show. Well, follow-on buying from Friday is what we're seeing. What would your approach be, and how would you approach it? Through the mid-caps or frontliners, or maybe a mix of both?
Yeah, very good afternoon. Yes, we were quite oversold on Friday when we witnessed the gap down opening. Because from a high of 22,750 to about 21,750, there was a 1,000-point correction in just 6 trading sessions without any meaningful pullback. So I think because of that oversold territory, we have seen some bounce back, and we have retraced 50% of that entire fall, which was around 22,285, and 61.8% is coming around 22,400. So we are expecting this up move to continue, this pullback to continue towards the 22,400 to 500 range. But as of now, the data is not turned that positive to consider this as a resumption of the uptrend. Because if you look at the FI's data, then they had about 57% long short ratio before 1.5 week. And as on Friday, their long short ratio is reduced to about only 35%. So aggressive short formations are there from FI's front. Now, how they roll over these positions, that would be crucial to see. So till then, we are looking at this as just a pullback move, and we might go through some time-wise correction in the short term, where on the higher side, 22,400, 500 would act as a resistance, and 22,000 followed by this swing low of 21,750 would be as a support. So definitely a stock-specific approach seems to be could work better for short-term trading, and I would recommend 2 stocks, a mix of large cap as well as mid cap. From the large cap space, HUL would be on the buying list. So one of the underperformer in the recent past, but there is some positive divergence along with the RSI now, where the price has formed a new low on the daily chart, but RSI has formed a higher low. So such positive divergences usually leads to at least a decent pullback move or retracement of the recent correction. So keeping a stock below 2150, we expect HUL to show some pullback move towards 2380 to 2400. And Raymond is a mid-cap idea where we have clearly seen a breakout from a long consolidation on Friday, a good follow buying supported by good volumes. So with stock below 1930, one can even go long on Raymond for potential targets of 2240 followed by 2300.
All right, Ruchir, thank you for that. HUL will be a very interesting one because reports its numbers day after tomorrow, and the street is not expecting much in terms of numbers, just about 2% volume growth, and that would be taken out by about 2% price erosion as well. The stock's down about 20% from its 52-week high, has been an underperformer. Let's see whether it can actually say that the volume growth is behind them, and going forward the street will look at growth more favorably for HUL because it's seen a lot of time correction and some price correction too. With that, we'll step into a short break, come back, get you more on individual stocks. AB Fashion and Retail is the stock which will be on our radar, up 5% now.
Welcome back. Well, for the markets, it's holding up very steady. No problems coming in. We have an advanced decline ratio, which is extremely strong in today's trading session. Not extremely, but fairly strong. So 2,700 stocks advancing and around 1,163 stocks declining. So it stands at almost 3:1, a little over 2. As you can see, the gap is extremely wide at this point in time. Well, just want to point out that M&M Finance will be releasing its numbers tomorrow, so do watch out for that particular stock and what they basically report. Even 361 will be reporting its numbers. Remember, it's up around 9% on a year-to-date basis, so that stock will be interesting to watch out for from a numbers perspective. But in any case, let's talk about Hindustan Zinc, which is in focus on the back of an inline set of Q4 numbers. The company has turned net cash at around 1,700 crores. Margins appear better because of top line was a little lower, but the absolute EBITDA is in line. Earlier today, we did speak to Arun Misra, the CEO of the company, to discuss the numbers and the demerger plans. Let's listen into what he had to say.
We are looking at price of around, we were hoping for a $3,000 per ton price in the month of December, but looking at the current sharpness in increase in prices, we believe that mark will be breached much before December. Somewhere maybe August or September, we should get a price beyond $3,000 per ton. Silver is currently about $28, $29 per troy ounce. It will cross $31, $32 per troy ounce because the globally, so we are now third largest in the silver producing company in the world. We moved up from 5 to 3, not so much by our increase, because of decrease in production of the many companies. Industrial use will continue to grow, whereas there is a recurring short supply of silver. So prices are bound to go northwards, and I see anywhere between $31, $32 per troy ounce is easily doable in the near future. No, I am not looking at that anymore because we are on the drawing board to double the capacity of Hindustan Zinc in India itself. We are currently producing about 1 million ton metal. We are working with various consultants to double the capacity of output from mines, at the same time double the capacity of output from smelters. We are on the conceptual design development phase. Another 2 months, by July, our design should be over. And if the reports are favorable, we'll take it to board. Maybe August, September, sometime we can come to market and announce what is our next phase of growth. But I am surely looking at something way beyond 1.5 million ton, what we had predicted earlier. We are working with government and they had certain objections to it, which we are, basic apprehension was government was doing the OFS and it was perceived that the restructuring at this point of time will be conflicting with the effort of OFS being done by the government. Now that the share prices are high, we believe that this is the right time to do the OFS for Government of India. And if that OFS can be done away with in 3 to 6 months' time, of course, it will be followed by restructuring of the company. Even if both happens parallel, we see no problem in it. And currently, our valuation in the market is about $20 billion plus. And we are looking at, if we do the separation of silver and lead zinc company, another $3 to $4 billion can be added to the market cap.
Right, that's some important commentary coming in from the management of Hindustan Zinc. The results were reported over the weekend, and then we have this up move that we're seeing on the stock price. But the other stock that we're talking about is Aditya Birla Fashion. Board has approved the demerger of Madura Fashion into another subsidiary of the company, eventually paving the way for the demerger of both the businesses. But there is some more incremental details on the sharing of debt between the two companies and fundraising. Vamakshi joins in with more. Vamakshi.
Well, absolutely, ABFRL in focus today. Now, keep in mind that back on April 1st, the board had only authorized the management to evaluate the potential demerger, and the very next day we had seen a very sharp up move of almost 11.5% in the stock. But now the approval has finally come through for the demerger. It will be Madura Fashion and Lifestyle business will now be newly incorporated into a company called Aditya Birla Lifestyle Brands. And in fact, they had earlier given a lot of information about the companies, but now there are incremental details that have come through as far as the debt as well as the fundraise is concerned. As far as the companies are concerned, two separate listed companies will be created. Aditya Birla Lifestyle Brands, which will house brands like Louis Philippe, Van Heusen, Alan Solly, Forever 21 as well as Reebok. Now this business on a 9-month basis, the revenue has grown by almost 5%. They've posted a revenue of almost 6,350 odd crores with a margin of 15.6%. This business is largely stable. They've posted stable growth, margins as well as cash generation, and in fact accounted for nearly 60% of the company's 9-month revenues as well as 75% of the company's EBITDA. Now, the incremental information out here that the company has disclosed is that the overall borrowings for the company stood at almost 3,000 crores for as on 31st of March 2024, and out of that 3,000 crores, 1,000 odd crores will be transferred to this business. The remaining ABFRL business, which constitutes of pantaloons, ethnic wear portfolio, digital brands, etc., will retain nearly 2,000 crores worth of debt. Apart from that, ABFRL is also looking to raise nearly 2,500 crores within 12 months of its demerger. Now, assuming the debt of 2,000 crores stays on till then, 2,500 crores comes in, essentially there is potential that the company could become net cash positive in the next 12 months. Largely, analysts believe that this whole development is positive for the company. It is expected to lead to value unlocking as well as strengthening of the company's balance sheet.
Okay, all right. Thanks very much for that comprehensive take, Vimakshi. Thanks very much. We'll take a short break, but once we come back, the big Q for today, post markets, and mainly for tomorrow will be Reliance Industries, which will be reporting its Q4 numbers this evening. Key expectations on the other side. Welcome back. Well, like we mentioned, the big Q to watch out for tomorrow and post markets today is the Nifty heavyweight Reliance Industries, which will be reporting its fourth quarter numbers. Manglam is standing by with details on what we can expect from its retailer, Reliance Retail.
Steady as she goes, Reliance Retail in the fourth quarter, the valuation and the value driver of the company in terms of growth. So what we're expecting is incremental improvement in both revenue as well as EBITDA. There will be improvement in the product mix along with operating leverage that would aid their margins. And at the same time, we'll see store expansion, which the company is on, along with increased footfall. So what does all of this mean for Reliance Retail in the fourth quarter in terms of numbers? We're looking at 21.5% growth in the revenues year on year. The number you're looking at is close to 84,250 crores. The EBITDA on the back of operating leverage and the factors that I earlier mentioned likely to grow by about 25%. These are estimates from Kotak, which implies a margin improvement of 20 basis points year on year as well, 7.3%. Now, if you look at this number quarter on quarter, it may look a little subdued, but remember, we're coming off the festive season. The third quarter is typically the strongest in the retail company for a year. And at the same time, if you compare that to the fourth quarter, then 1.5% revenue growth would not necessarily be bad. In fact, the other things that we'll be watching out for would be the commentary on store expansion and increased footfall. More importantly, watch out for the performance of their e-commerce business as well as the digital commerce business, which now accounts for nearly 19% of their sales. I'll particularly be watching the performance of their beauty store, Tira, of which the company has seen a fair amount of expansion out there. And finally, watch out for performance in their grocery, fashion and retail, as well as consumer electronics business too. So steady performance expected for Reliance Retail. Commentary more important.
Okay, all right, Mangalam. Well, that's on Reliance Retail, but Sonal is now here to tell us about Reliance Industries' oil to chemical segment.
It is expected to be a good quarter for the oil to chemicals business. So let's get started with the macros. Singapore GRMs, they increased on a sequential basis to come in at $7.3 per barrel. Additionally, spreads for various products were also higher. Diesel spreads, they were marginally higher. Gasoline spreads, they rebounded 40% on a quarter-on-quarter basis. And the petchem spreads, they were largely stable on a quarter-on-quarter basis. This throws up the EBITDA estimates for quarter 4. Expected to come in at 16,058 crore rupees, which is a slight dip on a YY basis, but a 14% increase on a sequential basis. And if we map it in terms of trends as well, it'll be around that 16,050 mark that we'll see in this quarter. Moving on to the oil and gas business now, that is where the EBITDA is seen at 5,500 crore rupees, which is an increase of 45% on a YY basis, but a decline of 5% on a sequential basis. But again, if we look at the trend, it has been continuously increasing in the oil and gas business, led by better volumes from KG-D6 basin. Let's talk about the volumes and the realizations. First up, the volumes, which are expected to increase 62% on a YY basis, a slight dip on a sequential basis. But if you look at the pricing as well, in terms of gas prices, they are expected to come in at $10.2 per MMBTU, which is an uptick on a sequential basis, but a slight downtick on a YY basis. But overall, the numbers will look decent.
Okay, all right. Thanks very much for that, Sonal. Well, over to Reema for key expectations from Reliance Jio now.
Expect a steady quarter from Reliance Jio, the telecom business of Reliance Industries. Revenue growth is seen up 2% quarter-on-quarter and a little more than 10% on a year-on-year basis. The CNBC-TV18 poll throws the revenue number at 25,900 crore for the March quarter. Margin improvement trajectory is likely to continue, and this quarter we are working with an EBITDA number of 52.5%, an expansion of 20 basis points on a quarter-on-quarter basis, and the profit jump is seen up 1 to 1.5%. There are two internal metrics that we track very closely. One of them is the ARPU, the average revenue per user, which is basically the monthly tariff. And that is seen steady. Remember, we've not seen any tariff hikes from the industry in more than 2 years now. So the ARPUs have been steady for the industry, 181.7 in rupees. And the second metric is the subscriber addition. And this quarter, we expect Reliance Jio to add between 10 to 11 million subscribers. Now, TRAI gives you the monthly subscriber adds. In the month of Jan, they added about 4 million subscribers. They added about 3.5 million subscribers. You add them up and you get to about 7.5, 8 million subscribers in 2 months. So which is why the 3-month estimate is seen closer to 11 million. But what's the street going to watch? Well, Vodafone Idea is doing that large FPO. So is there any tariff hike which is on the anvil? Because the street is expecting that post-elections we could see a tariff hike. And also there's a chatter about Jio IPO. So in the AGM, is the company going to talk about that? Or perhaps even in the press, in the Q4 conference call, I think there is going to be a lot of scrutiny on that.
Okay, all right, Reema, thanks very much for that. So that's on Reliance Industries, that numbers are expected post-markets today. Well, we'll take a short break. On the other side, Manisha Gupta will be with us. She's going to take us through what she's tracking in the commodity space. She has with her Siraj Hussain, the former Agri Secretary. Stay tuned. Welcome back. Well, before we get talking about what's taking place in the commodity space, just want to point out one particular stock, Spark, which we have been ever since the news broke about one of their key drugs not in fact seeing successful results when it came to Parkinson's. So the stock, just want to point out that the stock is down around 33% from the 8th of April, which is when it made highs of around anywhere between 450 to 470 odd rupees. It's been locked in lower circuit for 7 straight sessions post the news of the company deciding to end its ongoing study for Parkinson's for its investigational drug, Vodobatinib. Now, also remember that the stock, in anticipation of this particular result, had run up around 190% or thereabout from levels of around 160 odd from March of 2023 all the way to April of 2024. As of now, we understand that there are 76 lakh shares still outstanding at lower circuit. So maybe this downtrend could probably continue. it would be a stock to definitely watch at this point in time. But let's now go across to Manisha, who joins in for the commodities segment.
Well, thank you for that, Ekta. Also joining on the show now is the former Agriculture Secretary, Siraj Hussain. Mr. Hussain, thank you so much for joining us here at CNBC India. I, first of all, want to get your sense on the various heat wave advisories that we see coming almost every single day. Not such a bad scenario really in Delhi, but West, South, even Central India seems to be getting very high temperatures right now. And especially when you look at the latest CWC report, which is suggesting that 150 reservoirs in India hold capacity of just about 31% of activate capacity. It isn't really such a positive news to look at.
Actually, we should look at the data which shows what is the water level in these reservoirs as compared to 10 years average. Rather than the full capacity, we should look at the data of 10 years average. And if we do that, we find that Andhra Pradesh, Telangana are really a matter of concern because the water level in reservoirs is very low. But in other places, even if it is 10-15% lower, it should not be a cause of concern if the monsoon turns out to be a normal. So on the whole, I would say that if monsoon comes on time and if the early period of monsoon gets good rains, then our kharif crop would not be affected very badly.
Mr. Hussain, South really seems to be a problem right now where we are looking at a water capacity holding at around 17%. And there are various reports that we've seen come in, especially from Telangana, even from East for that matter. Jharkhand, Bihar are looking at strong heat waves. That is another area where the water is a bit of a concern right now. Would you say that normal monsoon, even if that comes in by first or second week of June, the months of April almost being done, May could be a bit of a concern?
Of course, it will be a matter of concern for people who are, working in the fields or working in the open because of too much heat and all that. But as far as agriculture is concerned, I do not think it should worry us unduly because the largest kharif crop, that is paddy, the transplantation, etc., does not take before that. It does not take place before that. So I think if the monsoon is on time as predicted by both IMD and Skymet, the kharif prospects are not unduly disturbing.
How are you reading the normal monsoon forecast as well? I mean, we're going from El Nino to La Nina and the transition is expected towards the second half of the monsoon. So the first half of monsoon, June especially as a month, both Skymet and IMD also are slightly jittery about. How would you look at the monthly distribution as per se?
Actually, as far as the science is concerned, it is very difficult to predict the monthly distribution at this stage. Even at later stages, the accuracy of these predictions may not be very high. Having said this, even the Australian models are showing that El Nino has almost ended and La Nina has started. So that is a very positive news, and I do not think that we should give too much attention to negative news and all that. I think we should believe the various models which are showing that monsoon is going to be good this year and the distribution is also going to be good. However, I must say that these predictions may not turn out to be fully accurate. There may be variations because as we have seen, even in years of normal monsoon, some districts of India, some regions do not receive the normal rainfall.
All right, we'll take in the good news right now, and that is about a normal and an above normal forecast coming in from both the forecasters there. My final question on the overall agri prices as we see them. We are looking at arrivals of Rabi, and we have seen that take prices actually onto the stabilizing mode. But even then, especially in case of pulses, edible oil prices, of course, have seen a bit of a decline. So pulses really seems to be a bit of an issue right now. Do you see that getting sorted with various measures that the government has put out?
Manisha, I do not think the government has taken various measures as far as pulses are concerned. And that is the reason why the production of pulses has gone down from 28 million tons to 25.5 million tons or so. In fact, the government did not protect the MSP of Chana in the previous 3-4 years. As a result of that, the area under pulses has gone down. And more worryingly than that, we are watching with dismay that the mustard prices in the mandis are lower than the MSP. The farmers are not realizing a fair price. Even in Punjab, where the diversification is the flavor of the town year after year, the farmers are not able to get MSP. So we do need government support and support through tariff adjustment to protect the MSP of mustard and other oilseed crops, especially soybean crop, which will now be sown, so that the farmers have an assurance that they will get at least a minimum price. In fact, we should do, there is too much of talk about self-sufficiency in edible oils and pulses, but that should reflect in our policies to support the farmers.
Well, that point is well taken. So one, of course, look at the good news, and that is about a normal monsoon. And the second is about some steps that perhaps still need to be taken when it comes to essential commodities, whether it's pulses or edible oils there, whether it's about MSP or supporting that MSP in sense of procurement. Mr. Hussain, as always, thank you so much for joining us and making sense of all of those numbers. With that, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.